Okay, well, why don't we go ahead and get started? Thanks for everyone who's joined here today. Welcome. Thank you again for joining us on today's webinar. I'm Jeff Butner, Managing Director here with ButcherJoseph, and I'm delighted to lead this webinar today with my colleague David Lake. Today we're going to be discussing updating your ESOP for new opportunities. And just a little housekeeping here before we get started. If you have any questions at any point during today's presentation, please type them into the Q&A box in your Zoom control panel. We'll be glad to bring them up during the presentation, and we'll also have time for questions at the end. Today's webinar, just so you know, is being recorded and will be available later through our website at ButcherJoseph.com and our YouTube channel. Any attendees are also welcome to contact David and I directly following the presentation and ask any additional questions you may have specific to your organization. And our contact information can be found here at the start of the presentation, as you can see here also on our website. So with those introductory remarks being said, without further ado, we'll go ahead and we'll get started. I think as we get a little bit deeper into today's topics of conversation, I think there's ultimately one sort of overall idea or concept or theme that really sort of governs much of the principles that we'll be discussing today, and that's this idea of durability. What's the durability of your ESOP is what we often think about or what we often ask, and when we say that, really what we're saying is, what is the durability of your ownership structure, which just so happens to be in the form of an ESOP. And I think that it's a logical question to ask for a lot of companies that have been living in the ESOP ownership structure for a longer period of time. And when I think about a longer period of time, it's typically going to be something like 10 years or more. And the reason that becomes a logical question to ask at that juncture is because, if you think about where you are in that phase, 10 years prior, you did your initial ESOP transaction. Over the first 10-year period of time, you've probably repaid all of your transaction debt that was used to finance the ownership succession from the founder owner. Your participants have probably been allocated a significant amount of allocated shares, the suspense account. Fact, many times companies are looking out on the horizon, finding that they have very few unallocated shares left in the next several years to allocate. Obviously, with those allocations of shares, your ESOP participants, after 10 plus years of share allocations, have probably built up significant wealth in their ESOP account balances, and are probably getting to a point where they're going to be seeking liquidity just through general purchase obligation requirements as that broad base of employees get closer to retirement age. The original leadership team that was in place at the time of the transaction may still be there, but maybe more in the twilight of their careers. And so companies may be looking and to address the next generation leadership, and management succession becomes an issue as companies are dealing with the next generation of employees stepping into what was previously occupied by prior leadership teams. And then, of course, you've just got general evolving industry dynamics, and how the industry may have changed in the last 10 years could look a lot different relative to how the industry operates today. You may have new entrants that have come in. You may have entrants that have left. I think one thing that we're seeing that is particularly different as it relates to industry dynamics is, you may have the same set of competitors as an organization that you had 15 years ago, but who owns that business today may be very, very different. 15 years ago, probably it was a founder owner, and most likely all of your competitors could have been founder owners. Today, there's a very good chance that many of your competitors are now owned by private equity. And, the fact that you may be competing, with a company that now is backed by private equity may create that a dynamic where they've become that much more formidable because they've got deeper pockets that can help them pursue growth opportunities and increases in market share that much more faster. So I think as we think about the durability of your ownership structure, oftentimes it sort of comes down to really sort of three things that you see here. One is capital needs, two is management incentives, and three is, again, evolving industry dynamics. And I think that as we interact with many companies that have been in that ESOP ownership for quite some time, they're looking out in the next several years and they're seeing a confluence of these forces sort of all coming to head simultaneously and coincident with one another, and trying to deal with maintaining relevance and maintaining the growth of the business becomes a challenge. I think that as companies are looking up and looking at these capital needs, the management, the succession, and the industry dynamics, they're trying to find ways to make sure that their employee ownership structure is supporting the growth initiatives of the business and not becoming a hindrance. Oftentimes, I think we find, as companies try to sort of navigate these confluence of forces, what happens is a bit of stagnation. It's a maintaining of the status quo, and maybe finding that they're sort of devolving into a scenario where they're really sort of managing the business a little bit differently around maintaining retirement account balances, managing repurchase obligation, and being a little bit less entrepreneurial than what they'd like to be. And ultimately, of course, as competitors are perhaps more entrepreneurial and have opportunities to grow fast, find themselves positioned in a way that maybe they're a little less competitive. There's a concern about being a little less competitive, or even over a longer period of time, devolving their market share and ultimately creating a diminution of value rather than an increase in value. So I think that it's not an uncommon scenario. In fact, if you find yourselves in a circumstance where this may sound familiar, you're in good company in a sense that there are a number of companies that we've helped and worked with over the last several years with dealing and addressing these types of themes, these types of issues, and try to find solutions to help a business continue to make sure that its employee ownership structure is supporting the growth of the business, the opportunities of the business, the outlook of the business, and again, not one that's hindering it. It encapsulates broad ranges of industries. Obviously, I think we've not found this is unique to any one particular segment, nor would I say that we found it's unique to any one particular size of company. This type of situation, this type of question of durability is very much universal across industries and across companies of a variety of sizes. Obviously, the objectives of each of the businesses might be a little bit different. The flavors of the desires might be a little bit different in terms of incentives and ultimately what the goals and outcomes are. But I think it's pretty universal that we see these companies that have been living in ESOP ownership for quite some time, have to sort of wrangle with this question of durability for the reasons we just explained. And some of that is driven inherently by the limitations of the regulatory and legal environment in which employee ownership has to live. S corporations are governed in certain ways, different than C corps, different than partnerships. and ESOPs separately and in addition to those, rules of legal ownership have their own specific requirements and rules for operation. And so I think it'd be helpful for my colleague David, as we talk a little bit deeper here today, to kind of walk everyone here, the audience, through some of those traditional ESOP structural dynamics. David, I think you might be on mute.
Yep, let me take that off mute. Yeah, so thank you, Jeff. Yeah, so what we wanted to do on this slide is just kind of show what sort of a traditional ESOP structure sort of looks like. And if you have an ESOP, you probably are familiar with this structure. It's quite candidly, this is the type of arrangement that when we're doing deals and setting up new ESOPs for clients, in the overwhelming majority of cases, we put folks in a structure just like this. And essentially, it's an S corp entity, right? That's 100% owned by an ESOP, and you might have, kind of a carve out for, management. We call that a management incentive plan, or a MIP, in the form of synthetic equity, SARs, phantom shares, et cetera. For like 10, 15%, some amount that's kind of dilutive to the ESOP, and that's typically how these are set up. And it kind of takes advantage of, of the sort of very beneficial tax rules. And, in I think it was 1998 when Congress passed the sort of the law that allowed S corp entities to be owned by ESOPs. You sort of get the best of both worlds, right? So you have an S corp entity, which is a pass through, so no tax at the entity level, and then a tax exempt shareholder in the form of an ESOP. So, as I said, best of both worlds, and you're able to avoid sort of federal and state income taxes, and life is great, right? And from a tax perspective, this is a highly optimal structure, and as I said, why we propose this in a lot of new deals. That being said, and as you'll see as we title this slide, there are some constraints here, and we've listed a few of those here at the bottom of this slide. And some of these, one class of stock, if you I'll tick through some of these. Eligible shareholder criteria, not accommodative to receiving outside capital. Those are, the ESOP or no ESOP, those are S corp sort of limitations. So, if you're not in an ESOP structure, you've got to contend with that. And you might be thinking, well, why would we ever want to have more than one class of stock? Well, if you're thinking about bringing in an outside investor, a lot of times those folks will want to invest through a different entity or have a different sort of equity, sort of security, et cetera. So that can be limiting. And obviously this structure is not overly conducive to those alternate structures. Then of course you throw on the ESOP, which can provide, an additional layer of complexity. Again, because this is such a beneficial sort of structure, the IRS wants to make sure that it's not sort of being taken advantage of, and you run into things like 409P. And this is certainly not a lecture on the nuances and the details of 409P. But suffice it to say, and if you're in this structure, that you definitely do not want to violate 409P. It's incredibly punitive. And even if you're, let's say you're well in the clear, it might be a burden to sort of, test and qualify for this year after year. So something to think about. And of course, and we'll touch on this at the sort of last bullet I wanted to mention here. And as I said, we'll revisit this, but that MIP plan, the 10 to 15%, that's great. A lot of times, in the beginning, because you'll allocate, that's a fresh pool of capital. So typically in the first year or so, that gets allocated to the managers that were important and critical when the ESOP was formed. But you fast forward 5 or 10 years, you could have a whole new generation of managers, folks that are in their twilight of their career, transitioning out, and then you're tapped out. That MIP plan's already been granted, and you've got to think about doing something else to incentivize those folks, because you might have a sort of an up and coming manager that you want to either woo over to your company, or you want to retain them and you want to make sure that they can get something in the form of equity if that's your intent outside the ESOP, which a lot of times, the ESOP has some limitations in terms of sort of how much can be sort of granted within that structure. So just a few sort of constraints of this structure. Again, a perfectly fine structure and lots of tax benefits, but there are some constraints.
Great, thank you, David. As we continue here, I think that again, as we engage with many of the companies that have been living in the ESOP ownership structure for quite some time, we talk to them and we dialogue with them about their experience at that stage of ESOP ownership cycle. We've noticed there's some common themes and common issues that again continue to sort of come up, and again it goes back to sort of, this is taking the first three that I mentioned down at one more deeper level here and getting a little bit more in the weeds here, and we'll continue to get a little bit deeper in the weeds as we progress in today's discussion. But some of the more common issues, obviously the first one being repurchase obligation, and clearly that is an issue that is unique to the ESOP ownership structure, and not something that companies that don't have an ESOP will have to contend with. Competitors that may be private equity based, of course, aren't going to be dealing with the purchase obligation. And the important part about repurchase obligation, as we think about it, is that obviously it is a demand on cash that's really sort of diverting capital from productive uses to an unproductive use. It's kind of just like a pension, and paying that pension means you cannot use those dollars to go out and make acquisitions. You can't use those dollars to go out and grow market share. You can't invest in your business. You can't buy fixed assets. It's not uncommon that we see companies that repurchase obligation itself has grown to the point where most of the annual EBITDA does not accrue to the balance sheet. It goes toward right out the door to repurchase obligation. And so obviously that can become a considerable issue for companies to maintain competitiveness and to grow if repurchase obligation is diverting such a large percentage of your annual earnings away from what could otherwise be used to increase value. And obviously what that means is, the company tends to really, stagnate in terms of share growth. Your management incentive plan shares just aren't going to have the same value accretion because you're not going to have the benefits of a growing stock price. To David's point earlier, the folks that had that management incentive plan in the first, 2, 3, 4, 5 years, the value increased considerably because of the fact you've got financial engineering and deleveraging of the balance sheet. You may not have that any longer. And so, there's a number of forces at play here that repurchase obligation can ultimately create that becomes really sort of a big focal point for most ESOP companies that are mature, and there tends to be only one perspective that people tend to gravitate toward as being the solution to that, which will be a sale of the company. But we'll talk through the fact that may not be the only solution here. Notwithstanding what I just said, that also can just lead to lost growth opportunities. Not only from the fact that you're losing growth opportunities because you don't have the capital to deploy since you're diverting it to repurchase obligation, but also from the fact that we tend to find and we hear and we see businesses again typically start to be managed in a way that is less risk averse. Again, managing toward the repurchase obligation becomes a focal point, and managing the business toward preservation of the wealth that's accumulated in retirement accounts again becomes the focal point. And so again, the business has lost that entrepreneurial spirit as a result, which inherently puts it on a path to potentially be less competitive with other competitors that maybe again are investing in their businesses and do have again the financial backing and resources to be able to pursue growth much faster than a mature ESOP company might, because of, again, other claims on capital that are more unproductive. So access to capital becomes a critical issue. It becomes one of the issues that we often talk to mature ESOP companies about the most. And again, as you heard from David, there are some inherent constraints in attracting outside capital because of the inherent limitations of S corporations and ESOP ownership, and the number of classes of stock you can have, and the type of eligible criteria, shareholder criteria you can have. It's very, very difficult to access capital that comes from anything other than traditional lending sources. When I say that, traditional lending sources are going to be those regulated banking, the regulated banking market that's been in place here in the U.S. for 100 years or so. Those are going to be very standard banking institutions. Your ability to get capital and access capital from them will be limited to your borrowing capacity on your balance sheet. Going to be pretty plain vanilla in terms of amortization structures over a shorter period of time. There'll be obviously a certain amount of capital that those lending institutions can provide. They can't go quite as deep in the capital stack as maybe they might like, just because of the inherent regulations. But in the last 15 years, there's been a proliferation in the U.S. of a non-bank market. Lenders that are credit funds and private equity funds, and that universe of lenders are not regulated. They're not bound by the same constraints as the regulated banking industry, which means they can be very creative. It means they can be very flexible. They can extend payment terms. They can lend deeper into your capital stack because they can lend based on cash flows. And it doesn't have to be a traditional, sort of debt security. It can be more of a hybrid-based security, be attractive, but that's difficult to attract. It's not very accommodative if your organization is that S Corp ESOP structure. So that becomes a common theme, an issue that we tend to hear, as well as this idea of just, again, incentives and making sure you've got the appropriate alignment of incentives, because as, again, demographics have evolved, you might have an older base with significant, retirement assets accumulated in the ESOP, and, they may not any longer be the folks that are really creating the value. Maybe you started, to transition some of the leadership of certain product segments, product lines, business units to a younger generation. Those folks, are the ones that are creating value. They're driving value in that organization. But, the incentives that are provided through an ESOP are obviously, not merit-based, so to speak. They're really just, based on an allocation formula that may create a misalignment of how many shares get allocated to those folks that are really the ones that you wish you could create value and get more value to, because they're the ones that are out there creating the value. And again, management succession is certainly not unique to the ESOP ownership structure. It's something every business faces, but it is something that, again, mature ESOP companies are facing, as I mentioned earlier. And the idea of being able to attract and retain that next generation of leaders can be a little bit cumbersome within an ESOP, because you don't necessarily have the same number of tools in the toolbox because of the inherent limitations, again, on the size of the management incentive plan pool, 409P constraints. We often hear that, it would be great if we could offer something to folks outside the bounds of employee of the ESOP that may be more equity based. Obviously, you can't do that in the S Corp structure, in the ESOP structure. But again, something to think about is certainly an issue that companies are expressing and looking to address. And so some of the goals that we're often hearing and what we're addressing and working with companies to try and find solutions for, which are, again, not all encompassing here on this slide. There's no one right answer. Most of the instances where we're assisting companies with solutions that are going to be very customized to the particular nuances of that business, its needs, its goals, which again, might differ from industry to industry. But clearly, again, improving the capital support, and addressing repurchase obligation is going to be a very typical goal. And, there's some of the ways I think you can think about addressing that are through maybe restructuring the operating or legal entities. I think, changing the ownership in some way, shape, or form is another way that I think you could help solve for some of the constraints that a lack of capital may be placing on the business. I think a lot of times, you know, people tend to think employee ownership has to be all or nothing. And ESOPs have to, be all or nothing. And, nothing's further from the truth. You don't have to be all or nothing. There are opportunities to have employee ownership through an ESOP that is somewhere in between 0 and 100%. I think there's also opportunities to continue to be, a wholly owned employee-owned company, but have employee ownership directly in the organization outside the ESOP. I think a lot of times what we hear from mature ESOP companies is we like being able to say that we're employee owned. We like we think that gives us a competitive opportunity to attract and retain employees because we can say we're employee owned. But employee ownership can come in a lot of flavors, and it doesn't have to just be limited to within the ESOP. It can also be outside the ESOP. But if that's something that is of interest, there's a lot of moving pieces and dominoes that would have to be considered alongside just that blanket statement. Again, repurchase obligation, I think we talked about some of the more common solutions, folks typically are professing, might revolve around just modifying the administration policies of the ESOP, or perhaps engaging in some sort of ESOP or leveraging transaction. We think there's probably a little bit more transformative ways to deal with that are a little bit more creative. Pre-funding repurchase obligation is something that I think is a unique opportunity to take full advantage of the capital markets today, the attractiveness of and the abundance of capital today at very low cost of capital, and maybe pre-fund those repurchase obligations, give folks a chance to have a little bit of liquidity earlier than what otherwise would have been the case, and help address a little bit of the repurchase obligation, today rather than in the future, and could be a very, astute corporate finance sort of arbitrage opportunity as well that, again, might be employed alongside a recapitalization or restructuring of the business based on, again, the type of capital that you want to use. I think some of the other goals is just trying to find ways to provide more meaningful incentives and really sort of, again, increasing the flexibility of the organization to have a greater breadth of tools that are used. Again, something more than just cash and bonuses, something more than just the management incentive plan. There's a variety of synthetic equity programs that are available, in use today that are less used in the employee ownership world simply because of some of the constraints. And one of those is authentic equity. Again, this goes back to the idea of having actual equity ownership outside the ESOP. And you're not bound by the same constraints of 409p and things of that nature. But again, it's part of a very holistic, transformative approach to revisiting how to think about the organization, the legal entities, ownership structure, and how you want to think about incentivizing folks. Overall, better alignment of incentives with performance, again, is another sort of similar type theme, and really trying to find a way where incentives can be more performance-based. I think the ESOP is a great example of allocating shares to your participants each and every year is a great example of a retention-based program. Doesn't matter how well they performed individually, they're going to get their allocation based on the administrative formula that governs your ESOP plan document. But maybe there's better, more creative ways to think about structuring something that's more performance related, either at the organizational level or even at a business unit level. Again, some of the constraints inherent to the S Corp ESOP structure will have to be considered. But if you're doing something more transformative and dynamic, with the organization, then you may have a greater amount of opportunities to use and deploy a broader set of tools that could help you address that type of performance-based incentive. The last three here, I think all kind of, again, sort of relate in some way, shape, or form, which is this idea that trying to figure out a way to optimize cash flow, increase growth, effectuate an environment of entrepreneurialism that maybe has been lost in the organization. And not only are we talking about organic growth, but also non-organic growth, initiatives. And what we mean by that is, acquisition opportunities, M&A opportunities. Obviously, I think as companies are mature, a company's strategy on a go-forward basis includes acquiring businesses more than it used to. When in the first 10 years of the employee ownership cycle, acquisitions really weren't on the radar. Most of the time, businesses were so indebted from the transaction. Their focus was, hey, let's just repay the debt. We'll grow organically. Let's repay the debt. Once we repay the debt, then I'll turn our attention to making some acquisitions. Now that you're in the 10 plus years of ESOP ownership and you have less leverage, non-organic M&A growth initiatives becomes more of a focus, more of a point of emphasis. We get calls all the time from companies looking for help finding targets to acquire that would bolster existing business lines or diversify existing business lines. And one of the things we hear, and one of the things that is of particular interest is, boy, wouldn't it be nice if I didn't have to use debt to finance those acquisitions? I would love to be able to use my equity as a currency. Obviously, companies that are not ESOP owned have the opportunity to use their equity as a currency to make acquisitions. It gives them a chance to not be as heavily indebted on their balance sheet, gives them more flexibility in financing those acquisitions, not just through the borrowing capacity of their balance sheet or the cash flows of their business, but from equity that they can issue to the target company that ultimately provides a less levered balance sheet, a stronger balance sheet. And that's something I think that really can be very intriguing and very interesting for a lot of mature ESOP companies if acquisitions are important. And improving, again, the ability to tap a broader segment of the debt and equity capital markets. Again, this speaks to the proliferation of the non-bank universe. I think everybody, is getting probably a lot of phone calls from private equity all the time to acquire their business. But there are opportunities to tap, again, a non-regulated universe of lenders who can provide growth capital. And they can be, as I said, very, very flexible in providing growth capital for acquisitions. It can be a hybrid security, maybe something like a convertible preferred security that, again, does not necessarily add just another element of debt. And maybe that helps the organization address repurchase obligation, allows it to address growth initiatives, organic growth, internal investments into operational efficiencies, modernizing facilities, and all at the same time pursuing acquisitions. So I think as businesses get to this inflection point where they're dealing with this confluence of forces, they find themselves, initially the knee-jerk reaction is there's two common alternatives, but there's really a third that exists that, we've been focusing on today. So I'll ask David to talk about some of these common alternatives and a bit of the pros and cons of each.
Yeah. And the good news is, I know we threw a lot of goals and issues at you, and maybe some of those are resonating more than others. But the good news is you've got some options here, right? And we laid out sort of, as Jeff mentioned, there's the two that you're probably familiar with, right? Just maintaining status quo and selling the company. We've added a third here, this ESOP refresh concept, which we'll revisit here in a second. But, and of course, there's, this is a simplification. Many of these can be broken down into in more and more options, but we wanted to just kind of provide the highest level buckets here as far as options. And there's advantages and disadvantages to each of these paths, and we'll kind of talk through some of those. Obviously, the path of least resistance is probably maintaining status quo, right? But I think we'd say that it may be the easiest path. It certainly is not without risk, right? If you're operating in a highly competitive industry, a lot of times you've got to be very nimble and mobile and evolving. And if you don't, that could be obviously incredibly risky, right? There's a lot of sort of those managerial phrases out there, if it ain't broke, break it, and evolve or die. And I'm not, we're not going to dwell on sort of those issues or sort of slogans, but wanted to point out that this is a somewhat kind of risky path. That being said, there are a number of advantages, right? And we've sort of laid out those here. If you're not going through a sale process or even raising capital, you're not disclosing any information to anybody, right? So that's obviously provides some comfort that the secret sauce, so to speak, is not being shared with either neutral parties, i.e. lenders, or potentially with folks you're in direct competition with if they're being included as buyers, which they often are. And then of course there's no negotiation. So, in the case of a sale transaction, that could take several months to complete, as I'm sure most of you know. And a lot of it is relative, there's some painful points in that process, right? There's negotiating fine points, and that part of the process alone could take several weeks of bidder negotiation if you've got a sort of a value focused buyer. Some of the benefits are, of course, you retain 100% ownership. You have no third party in whatsoever, good or bad, of course, because a lot of times they're looking to sort of enhance their investment. You get to maintain operating control, et cetera. It's stability. We put a question mark on that one. This is second to the last bullet here, stability for employees and community. Questionable. A lot of times it is. Sometimes, as we mentioned, a change, you're kind of at the right point for a change or what have you. Of course, that doesn't address any repurchase obligations, as Jeff mentioned, as the ESOP ages and as you deleverage, et cetera, the shares become more of value, which of course is a good thing. But on the flip side, you've got to have the cash and capital available to pay out for those folks that are retiring and leaving the company, et cetera. And it doesn't address, we put in a few other bullets in here, obviously, if you've got a mature ESOP, a significant fraction of your employees' wealth is tied to that company, right? Which is, almost like double dipping. If you think about a 401k, obviously, which is kind of a typical retirement alternative to an ESOP, certainly their job and their well-being and their paycheck is tied to their current employer, but they've got wealth in the form of, other public companies. So they're not sort of doubling down, so to speak, on their current employer. So just kind of a quick overview of the status quo sort of / do nothing scenario. And we move into, of course, the sale of the company, which can, as we mentioned, is a big step, and it's not something that should be taken lightly. And of course, sale of the company doesn't mean sale of 100%. It doesn't even mean sale of control. You could have, you could have a minority sale where 20% of the company is sold. You maintain the ESOP, and you move forward in that environment. But either way, there are some advantages and disadvantages here. Of course, if you're in an industry and as we've seen with interest rates as they are now, and with the stock market performing as it is, you could be in a position, and a lot of industries are, where you're seeing multiples and valuations you've never seen before, right? On the high end, that's a good thing. So selling the company or selling a fraction of the company locks in that value that may not come around again. So obviously something to consider. And if you've got an ESOP that's 20 years old or so, you've had a good holding period of that investment, and maybe it's time to sort of exit, if you will. So that's obviously a benefit of the sale pathway. We mentioned obviously concentrated wealth for employees with the sale. With those folks, they'll roll their employee balance, either into cash, depending on how the sale is structured, or into some other kind of retirement security, i.e. a 401k. Takes care of repurchase obligations. Those largely go away in the case of a sale company if we're talking about a full sale. But of course, like we said, there's some disadvantages. You've got to share information. It's going to take some time. You've got to carefully scrutinize who you're speaking with and who gets what information, obviously, if we're talking about competitors. And then, of course, operating control, depending on the fraction of the company sold, you're going to obviously lose full control or any control. Business continuity. In the case of the strategic buyer, there could be a name, God forbid, a name change or something like that. So obviously, business continuity is something that's important, and it usually is. That's something to consider here as well. And of course, employee continuity. Nothing anybody wants to talk about, but a lot of times, particularly with financial buyers, they're going to look for ways to cut costs. We all know that. So that leads us to the ESOP refresh, which obviously is the focus of this discussion. And of course, there's no perfect solution, and we're indifferent. We a lot of times we'll meet with folks, and sometimes a sale company makes more sense than a refresh, and vice versa. And sometimes status quo makes the most sense. And we'll say, let's talk in 2 years, 5 years, or what have you, when a sale or a refresh might make more sense or be more impactful. Probably see some of the benefits of the refresh, like we're talking. To the extent the ESOP is working, which they typically tend to do, that continues obviously in full force. You maintain operating control. We'll get to some of the kind of the flavors, but a lot of times as part of a refresh, we'll raise some capital. So we'll talk to a lender, usually a friendly party, a senior bank or a community bank, and get them to provide some capital for whatever the purpose, and more on that later. And it could, segueing into the next bullet, could be to pay for some of the repurchase obligations, to pre-fund that. And of course, little to no disclosure of proprietary data. There is none at all if you're talking about no capital raise, and otherwise you're dealing with sort of a friendly party in the case of an established banking relationship. Of course, some of the considerations are, you still have this ESOP structure in place. So you still have to contend with sort of repurchase obligations, any complexities involved with sort of dealing with that ESOP going forward. But a lot of times obviously the purpose of the refresh is to understand what the specific objectives are, and then plan and design the refresh around what those are. And that goes back to sort of the goals that Jeff walked through, and sort of, we kind of talk through, okay, which of this list sort of makes sense? What are you focused on? And then we can design the refresh around accomplishing and achieving those goals. And so that's really the last bullet we have on this page here, and within the refresh is, the bottom line is, if what the refresh is meant to accomplish is, if you've got, whatever the case may be, if you need a little bit of capital, if you need to tweak the company structure a little bit to bring in that new manager, maybe to keep that manager, maybe to make the acquisition, the refresh can be designed around that to achieve those growth objectives and effectuate change to the extent that that's what you're thinking needs to be done.
Perfect. Thank you, David. So we thought it might be helpful to kind of walk through a couple of examples, case studies of circumstances where, um, a particular mature ESOP company, expressed some desires to do something transformative, something more than just maintain the status quo, which obviously in and of itself is not transformative. And this particular case study, and we've got a couple here, but this particular case study and it involved a company that had been an S corp ESOP ownership, ESOP owned business for over 10 years. They found that their earnings were range bound, and again, stock price was appreciation was fairly elusive. And that's because of the fact that, again, most of their earnings was going to repurchase obligation each and every year. So there's no deleveraging in the balance sheet that would assist with that. There was no cash buildup accumulation on the balance sheet. And frankly, EBITDA wasn't growing. And again, EBITDA wasn't growing just because of some of the dynamics that they had around their employee demographics. They had a lot of folks that had really, really sizable ESOP account balances and were really risk averse, really weren't incentivized to go grow value. At the senior leadership level, who were near the point in their careers where they were going to be transitioning on and retiring and bringing in next generation. Their repurchase obligation, as I said, was very, very large. And while they recognized that there were growth opportunities, they essentially were frustrated by the fact that they couldn't manage all the opportunities alongside repurchase obligation, alongside internal investments they needed to make just to continue to maintain existing operations. Your maintenance CapEx. Didn't have an opportunity for any sort of growth CapEx, for example. And as a result, their overriding theme is concern at the leadership level and at the board level was ultimately they were kind of felt like they're setting the organization into a period where it was not just stagnating, but ultimately was going to be less competitive. They lose market share. They couldn't respond as fast to competitive dynamics as other non-ESOP owned businesses that had greater strength and capital to on their balance sheet or through private equity ownership to pursue growth opportunity. And as a result, sort of put the company on a slow path to being less relevant and really kind of sort of slowly destroying value over time, which again goes back to concerns about preserving the retirement assets that had been accumulated. So, as we came in, we considered a lot of alternatives. We worked on a variety of scenarios, looked at a lot of different potential alternatives, including what the status quo looked like, certainly considered a sale transaction. But ultimately, at the end of the day, this was a business that was and is a professional services organization. And people is very, very important to them. They like the idea of being able to say they're employee owned. They recognize that there was opportunities to sell the company to competitors, but we're concerned about what that might mean for the broader employee base. And so we walked in and helped them sort of navigate through a refresh transaction where one of the components was to, again, take advantage of the robust capital markets and give active employees an opportunity to have a special diversification opportunity. What I mean by that was the company, we went out and raised some capital, which was a committed pool of capital, and a offering was made to all active employees that would allow them to monetize their ESOP dollars sooner than what would otherwise have been the case. Allowed those folks to roll over those dollars into a 401k. Obviously, that helped with the diversification issue, and allowed folks to capitalize on the value that had accumulated in their ESOP retirement accounts, and then make that concern less of an issue at the board level. And growing the organization now could become more of a point of emphasis since the retirement assets had just been somewhat preserved. And each, employee had an opportunity to make a decision, an election as to how much of their account balance that they wanted to monetize earlier rather than later. I'll tell you, it was a very successful diversification opportunity. It was oversubscribed, and I think it was a very positive result in a lot of ways. One of the other interesting dynamics with this business that was a concern for them was they had actually, over the course of the last 10 to 15 years, really started to grow their international operations more and more. It started to become a situation where the international operations were growing faster than the domestic operations. U.S. operations had kind of stagnated. Any new employees that were hired were not hired in the U.S., they were hired internationally. And those international employees kind of felt like second-class citizens and didn't have an opportunity to participate in the ESOP. And the organization wanted to find a way where there was something that could be structured that mirrored the experience that ESOP participants have with owning stock in their employer and in the growth of and appreciation of business when those opportunities were generated by the international operations. So we restructured the business. We raised some capital. By restructuring, we were able to provide an opportunity to establish an organizational entity that was more conducive to attracting outside growth capital from private equity and from other credit funds. Another key desire was, again, for this business, at least domestically here, to grow their domestic operations through acquisition. As I mentioned, because most of the growth had been internationally based and not much had been, here in the U.S. The U.S. operations had stagnated. It was more mature than the international operations, and the company recognized that if they wanted to grow the U.S. operations, it really needed to be through acquisitions. And again, being able to provide or use, I should say, the company's equity as a currency for acquisition was really important for them because it allowed them to then limit the debt on the balance sheet while still pursuing growth opportunities. And whatever debt they did take on, it could be funneled toward repurchase obligation. It could be funneled to investments in the business. They can expand and invest in people. And, as the dust settled and we look up today, it's fortunate the company's been very acquisitive. They've increased their market share as a result of those acquisitions. They've diversified their business because the acquisitions that they've made have been in product lines that they didn't, previously offer. Also in different geographic territories that, they didn't particularly have a presence previously. Obviously, that helps reduce business risk and ultimately, has increased shareholder value, relative to what was the status quo going into, a consideration or a contemplated, transformative event. David, you want to talk through case study?
Yeah. So I think if you're even reading ahead and as we discuss this, I think you'll continue to hear a lot of the same themes. I would point out that case study A, Jeff mentioned, that's professional services. Case study B is actually a company that's in the contracting space, specifically HVAC and plumbing. So very different workforce. So illustrating the fact that sort of a similar type of transaction or a customized transaction can work in very different industries and accomplish a lot of the same goals. So just wanted to point that out up front here. But again, a lot of the same kind of sort of background with this company. They've been around for I think about 100 years. The ESOP was a more recent ownership structure that had been employed here, 15 years or so that they had been ESOP owned. And it was one of those situations where enough time had passed that there had been a little bit of turnover at the management ranks. Some new folks had come in. They had largely tapped out that synthetic equity pool that was created 15 years ago. So the thought was, okay, well, we need to do something to, just as we did with that first generation of ESOP managers, we need something in the form of equity outside the ESOP to incentivize this now second generation of managers. And what was interesting here is this was a company that were kind of at a turning point, even though they had been around for, as I mentioned, a century. They really were kind of, they had a CEO that was really very ambitious and wanted to kind of partner with a lot of different industries. So we wanted a structure that was flexible enough that if he were to bring in an investor, it could accommodate that sort of investment. So that's exactly what we did. So we organized, we converted the structure, actually brought in some an LLC entity structure, which was very amenable to, in the case where, you might have a third party investing. We actually raised some capital, and largely that was used. So I mentioned they were looking at, having an outside firm invest in them. They also themselves wanted to make an investment, a small company by their standards, but it was something that it provided them to get into a new geography. They're based largely in the Northeast. This was a company that was in the Southeast, obviously an area that's exhibiting lots of growth and has, you can imagine, very robust HVAC needs in the Southeast. So that was an acquisition that we helped with the kind of the buy side diligence, as advisors, and also raise some outside capital as part of this ESOP refresh. And then we did some other things too that were interesting. We provided the employees an opportunity to invest outside the ESOP. As I mentioned, we created that equity pool for the next generation of managers. So they've got sort of a carrot beyond just the ESOP equity, which is always good for those folks in the senior ranks. And it's been great. This was a client we had a number of years ago. I think they've over 5 years have almost doubled their EBITDA and their cash flow. So it's obviously worked out well for them, and I think they've actually even benefited from some of the pandemic things that have obviously challenges to a lot of industries and companies. So just a great story all the way around. Jeff?
Yeah, and one thing, just to piggyback on what David said, to punctuate, because I think it's really interesting and unique here with this particular company, this idea of employees provided an opportunity to invest outside the ESOP. What that means is, employees wrote a check and actually bought equity outside the ESOP, and annually were provided on a go-forward basis the opportunity to allocate a portion of their bonus to buy more equity. And the reason we structured something that way, because one of the things that was important to this company is they didn't want another incentive program that just gave employees something for nothing, which is essentially, as we talked about, kind of what the ESOP does. It's not merit-based. It's everybody gets allocated something. They wanted something that would require folks to invest, minimal dollars, but they felt like they would get more employee engagement and sort of really reinvigorate employee behavior and motivation in that form or fashion because of this. And I think they were right, because if you think about it, we saw in hindsight a different level of engagement and commitment by folks who actually wrote a check versus folks that just get something for free, or lack of a better word. So really interesting, unique set of circumstances there that I think is not to be lost in the shuffle here. We're almost at the time limit here. I think we have a final slide. I'm not going to go through it at this point, but I think just some following questions to ask yourself offline as you think about your particular organization. But I would like to invite anyone that may have any questions to please ask them. And we're happy to stay on a little longer to the extent you may have some. To the extent you don't, that's fine. As I said at the start, you're welcome to contact us later directly. Give folks a few more minutes here. I don't know how long it might take to type, so
Yep.
Don't want to cut anybody off here, but So it looks like we do have a question. The question is, how does the company start the process to understand if a refresh might work? It's a good question. I think that the way these processes typically start, is at least initially a more direct conversation about the business and some of the dynamics of that particular company. Obviously, that generally involves a meeting and a sharing of information that would help give a little bit of a lay of the land to us as to some of the dynamics that the business is dealing with. Obviously, very much a dialogue between the key leaders of the business about what they're facing and the issues that they're facing, what they like to solve for, and what the goals are, and really sort of kind of creating that little bit of that wish list. And then as we have that wish list, and then we can start to think about the solutions that will allow the organization to be able to find that it can achieve the goals to tick off each of the items on that particular wish list. So that generally is kind of how we would typically start with clients and engage with folks, is a conversation, sharing a little bit of information. It's not a lot, but a little bit of information, I think, in a conversation can go a long way to kind of giving help to paint the sort of a picture of the landscape, and then think about some of the potential solutions that could be an option in light of those desired goals. Okay, it looks like that may be the only question we have for the day. So with that, I want to go ahead and on behalf of David as well, and Rose, thank everyone for joining us here today for this webinar. We really appreciate you carving out some time and joining us. I hope you found it informative, and obviously, would love to hear from you. If you have any other additional questions, please feel free to reach out to any one of us. And
Absolutely.
have a great rest of the week, and nice weekend.
Yeah, thank you, everybody. Bye-bye.
Bye now.